Markets finished on a positive note today as everybody gets ready for the inflation report coming out on Thursday. And then, of course, Fed speakers and their response to that, and earnings, which are on tap for this week, next couple of weeks, starting with the banks. So right now, the Dow finished up 0.5, S&P up 0.7, NASDAQ up 1%. It's a 3-day win streak for the NASDAQ. So markets are trying to put a little floor under things temporarily. And if we get, as we talked about in the last couple of videos, if we get a nice inflation report, meaning inflation is still coming down, markets are likely to rip a little bit. But the last time that happened, markets bounced significantly on a lighter than expected inflation report and then ultimately reversed because of the Fed's response to that. And the Fed's already coming out ahead of all of that, talking about Powell saying that the Fed might have to make unpopular decisions to stabilize prices. Fed's Bowman says there's a lot more work to do to bring down inflation. So they're coming out in advance of the inflation report. And this is Chairman Powell, Jay Powell, his favorite statement: price stability is the bedrock of a healthy economy. He uses that word price stability a lot instead of inflation. And, I don't know however else you would define that. But anyways, price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy. So they are basically telegraphing, I think, that 50 basis points is still a good likelihood and possibility for their next meeting, even if there's a good inflation report, because the markets are likely to rip on that. And the Fed wants tightening financial conditions, not easing of financial conditions. So we shall see what that starts to look like after the inflation, after earnings and things like that. So the market's got a lot to digest coming up here in the next couple of weeks. Breaking news: Wells Fargo, once the number one player in mortgages, is stepping back from the housing market because of high interest rates. Wells Fargo is stepping back from the multi-trillion-dollar market for U.S. mortgages amid regulatory pressure and impact of higher interest rates. So we are acutely aware of Wells Fargo's history since 2016 and the work we need to do to restore public confidence. That the chairman said in an interview, as part of that review, we determined that our home lending business was too large, both in terms of overall size and its scope. So what's happening basically is the banks are losing money on loans that they've given on houses recently because the housing market is correcting. They lent too much money. Those loans are starting to be at break even, potentially underwater. So when that happens, it becomes an interesting dichotomy for the banks and for investors and financial institutions to digest. In other words, they don't like that imbalance. They want their loans to be worth less than the asset that they loaned on. Unlike the vehicle market, where they were lending 1.25 times the value of a vehicle, because vehicles are depreciating assets. But with houses, with real estate, a lot of times borrowers will walk away if they end up underwater or their houses and real estate lose value, like we saw in 0809. The difference this time is most of the mortgages out there are at record low interest rates, sub 3%, a lot of them in the threes, but some of them are sub 3%. So people aren't likely to walk away from that unless they absolutely have to. And right now, inventory levels are still tight in some areas, but could come under pressure in others. And if houses continue to get underwater, that could put pressure on the housing market and create a problem for banks. So we'll hear more about that as the banks report potentially coming up soon, as well as the strength and the health of the consumer. As we can see, the Dow still making that move. We were looking for a little Santa Claus rally. Santa's been late to the party, but overall, a 3% move. We were looking for 6 to 7. We've got 3 out of it so far. I think if we get a good inflation report, we'll likely test this upper region of the Dow at 34.7, potentially a little higher than that, put in a higher lower high on this trend, and then roll over on itself once the Fed comes out and starts slapping it down once again. NASDAQ could work its way all the way up to this trend line. So could the S&P, which would put the S&P around 3,900, 4,000. That's been a big resistance area, that 4,000 area, before it ultimately rolls over and goes to test this low, potentially put in a lower low, depending on what earnings looks like, recession watch, things like that. Here's the VIX. kind of working its way back down to that 1920 level. And we know whenever the VIX gets there, that is time for markets to kind of reverse and rally a little bit. When the VIX is high, that is time to buy, meaning markets are probably dropped. The Dixie is continuing its reversal here, has not found support yet. The 10-year did get a little bit of a bounce, so we'll see if that continues and what happens. And if the 10-year drops, some people are projecting in the 3% range plus or minus, more likely plus. That is not a good sign for the market, so we'll have to keep an eye on that and see what that looks like overall. Let's get into crypto here. Bitcoin continuing its little run. Like we said, I'm targeting this level here, about 18,000, that this could potentially hit with a good inflation report before ultimately rolling over, retesting these lows. And then if markets go to new lows, Bitcoin will likely get down to that 12, 13, 14,000 level, consolidate around there for a while, and see if we can start putting in a base in the markets and the economy on the heels of this inflation. Here's Ethereum working its way up to this range, XRP, Cardano, pretty much everything having the exact same price action. Here's the interesting thing about Bitcoin, though. This price action right here looks almost identical to this range right here, kind of popping its way up, dropping, popping again, and then ultimately rolling over. And it kind of seems to be doing the same kind of thing here in these waves. This was obviously a bigger range here. This range overall was from wick to wick was about a 42% range. Let's see what this range is. These ranges are getting tighter, which is good. In general, that's a 17% range. So the next level down could be the last leg down potentially in a very tight range of accumulation. So this is liquidity hunts here, hunting stop losses and just, creating liquidity and liquidating positions. Same thing going on here, but that's getting less and less aggressive as we go through time. Big one up in here. So the next leg down could be a tight little consolidation range for accumulation and potential carving out of a bottom as we go into Q1 this year and start looking at all of the other things that are affecting the market, including what we just talked about, real estate, health of the banks, things like that. So a lot of stuff. Still, the economy is still kind of treading water on thin ice, whatever you want to say, walking a tightrope. A lot of ways to talk about it, but still a lot of uncertainty out there. But if we get a good inflation report, could get a nice little rip in the interim while we await the Fed's response to that, earnings, and then ultimately the next interest rate hike, which right now is looking more like a 50 basis point versus 25. So these are the things I'm looking at. I'll see you in the next video.